Right, complex groups continues. This is the third of the videos in the area of complex groups, and now I'd like to turn my attention to question Rodney. So we're now going to do question Rodney. It's an old exam question. As I mentioned in the previous recording, it's an old exam question that I have tinkered with half to death. It was originally written by the examiner Graham Holt in December 2002, or at least it was examined in the ACCA examination in December 2002, and obviously back then the rules were different, and therefore what I've done is I've taken this question and I've jiggled things around a little bit, made it more up to date, and basically just brought it into focus for the present accounting rules. But to all intents and purposes, it's an exam question. Now, the way that I propose to record this exam question for your benefit is to break it down into two videos. The first of those two videos, I'm simply going to wave my hands about and talk about the question and how to work your way through the various paragraphs and how to pick up the maximum number of marks in the time allowed. And then what I'll do is I'll stop the video and then I'll record me actually doing the question. Okay, so we're going to get two recordings of the question, Rodney. The first is me simply talking it through, and the second is me doing the question. Now, you may find it useful that in the back of your pack, here's my pack here to the left-hand side. In the back of your pack of questions, you have the answers. Now, what I've done is I've put a... Oh, goodness me, it just happened to open on Rodney. That really is Rodney. That's a stroke of luck, isn't it? So there is Rodney that it just opened at. What I've done is I've put an incredibly detailed, really detailed answer in the back. Far more than you could ever hope to do or would ever indeed want to do in the examination. But I've put a lot of information in there by way of supplementary explanation. So what I'll do is I will talk through the question, very much showing you the way through this difficult question. Then we'll stop, and then I'll have a separate recording for me actually doing the question. Okay? So that's the plan. Should we start? We should start with the requirement, shouldn't we? Required. Prepare the consolidated statement of financial position of the Rodney Group as at the 30th of November. 35 marks. Now, there are in fact 35 marks of numbers based around group accounting, and these were the 35 marks from December 2002. So here we go from the top. The following draft statements of financial positions relate to Rodney, a public limited company, Dell, a public limited company, and Trigger, a public limited company. Ta-da! Look at the balance sheet. Now, ideally, in your exam, I would like you to pick up as soon as you possibly can that you have complex group accounting. Now, you can tell that you have a complex group because do you see that Dell has ownership in Trigger? Can you see that? It says investment in Trigger 160, and then shunted across you have the figure of 100. That's Dell's ownership in Trigger. Well, if Dell has ownership in Trigger, Dell must not only be a subsidiary, but also must be a sub-parent. And therefore you have complex group accounting. Exactly how the group works, you don't know at the moment, but you know you have complex group accounting. So the ideal is that in the examination you will look at the balance sheet and instantly identify that you have a complex group structure on the basis of some mid-sub ownership in the sub-sub. I must admit, you'd be doing pretty well to pick this up, but I've picked it up, so I might as well say it out loud. Can you see that we have a revaluation reserve in Trigger? But we don't have one in Rodney and Dell. So we can definitely tell that two of the entities are doing the cost model for property, plant and equipment, and one of the entities is doing the revaluation model for property, plant and equipment. So there is an inconsistency in policy between the parent and one of the subsidiaries. Now, which way should you go? Which one should dominate? Should it be the parent policy dominating or the subsidiary policy dominating? Well, of course, it should be the parent policy dominating, which means you're going to have to get rid of that revaluation reserve. You're going to have to go back to cost accounting for trigger. I think you'd be doing pretty well to pick that up off the balance sheet without reading anything, but nevertheless, it's true. Reading on down, it's the group's policy to value the non-controlling interest at fair value. The following information is relevant to the preparation of the group financial statements. 1. Rodney had acquired 80% of the ordinary share capital of Dell on the 1st of December 2000. Did I say that right? On the 1st of December 3 years ago. Why did I say 2000? I don't know. Rodney had acquired 80% of the ordinary share capital of Dell on the 1st of December 3 years ago when the retained earnings of Dell were 100 million. The fair value of the non-controlling interest was 154 at acquisition. The fair value of the net assets of Dell was 710 at that date. Any fair value adjustment related to the inventory, and these had been realised by the current year end. There had been no new issue of shares since the current group structure was created. Well, that's a lot of detail for one paragraph, but one thing it's definitely saying is that Rodney holds 80% of Dell. So we have parent-sub structure to start with. Paragraph 2. Rodney and Dell had acquired their holdings in Trigger on the same date as part of an attempt to mask the true ownership of Trigger. Rodney acquired 40% of Dell. Rodney acquired 40% of... No, that can't be right. I'm misreading it, aren't I? Rodney acquired 40% and Dell acquired 25% of the ordinary share capital of Trigger 2 years ago. Gosh, I always find these questions really difficult to read. Even though I've looked at this question 20 million, bazillion, gazillion times, I still find them difficult to read. One of the things I find really difficult about this question is the percentages are given in words rather than numbers. And it's amazing how a little change like that can make a difference to the way you read a question. Rodney acquired 40% and Dell acquired 25% of the ordinary share capital of Trigger 2 years ago. Now, I don't know about you, but I'm confused already. Who's owning who? What's going on? What is the group structure? I've figured out it's a complex group, but which one? Well, you'll hardly be surprised to hear that on the basis of what we saw earlier in the previous recording, this is, of course, a D group. So I'm going to show you the D group section. I'm not going to actually answer the question, but we are going to do the complex group structure now. So question Rodney. Let's at least do the complex group structure. Have you figured it out? Because I sure of heck haven't. Have you figured it out? It's a D group. Well, let's just double check. From paragraph 1, Rodney acquired 80% of the ordinary share capital of Dell. Yes, indeed, 80%. That would give you R as being a parent and D as being a subsidiary. But next, paragraph 2. Rodney and Dell acquired their holdings in Trigger on the same date as a part of an attempt to mask the true ownership of Trigger. Rodney acquired 40% of Trigger. That is the direct ownership, 40%. Rodney acquired 40% and Dell acquired 25%. Dell acquired 25%. Can you see it now? So what we have is we have a similar sort of story to that we had in the previous question. Previous question being, I've just turned to the page there, haven't I? But what was the previous question called? D, slight return. Do you remember that question? D? It's very, very similar to that, the structure that you have in front of you. So what you have is you have a direct ownership and an indirect ownership. The direct ownership is this 40%. We, the ultimate parent, own 40% of Trigger. We know that because it says. But the indirect ownership requires calculation. The mid-sub owns 25% of Trigger, but we own 80% of that 25%, and therefore own 20%, and therefore the combined ownership is equal to 60%. And from that we can get the NCI as being 40%. So there you go. We have a complex group structure, we have a D group, as you often do when it comes to complex group structure. So continuing on with paragraph 2. Rodney and Dell acquired their holdings in Trigger on the same date as a part of an attempt to mask the true ownership of Trigger. Rodney acquired 40% and Dell acquired 25% of the ordinary share capital of Trigger 2 years ago. So Rodney, acquired Dell 3 years ago and acquired Trigger 2 years ago. Rodney acquired 40% and Dell acquired 25% of the ordinary share capital of Trigger 2 years ago. The fair value of the NCI was 149 at acquisition. The retained earnings of Trigger on that date were 50 and those of Dell were 150. There was no revaluation reserve in the books of Trigger at acquisition. The fair value of the net assets of Trigger at acquisition were not materially different from their carrying values. Well, there's an awful lot of information in paragraphs 1 and 2, but the main thing in paragraphs 1 and 2 is the relationships between the three entities. And I think the relationships are established, so I'm going to suggest we look at the other bits and bobs. Can you see that the fair value of the non-controlling interest given in paragraph 1 is 154, and the fair value of the non-controlling interest given in paragraph 2 is 149. If the fair value of the NCI is given, you must use it. If the fair value of the NCI is given, then the policy of the entity must be to use the NCI at fair value. So we're going to be using the 154 as the fair value of Dell NCI at acquisition, and the 149 as the fair value of Trigger NCI at acquisition. That's the first thing to say from paragraphs 1 and 2. Back to paragraph 1. Can you see the fair value of the net assets of Dell was 710 at acquisition? Now that's the fair value of the entire net assets. Now what the examiner is expecting you to do is it's expecting you to work out the book value of the NCI. The book value of the entire entity. Compare the book value of the entire entity to the fair value of the entire entity to work out the fair value adjustment as a balancing figure. Now I'm going to do the detail of this in the next recording, but I just feel like talking it through and seeing if you can see it for yourself. Before I do that, what's the fair value adjustment on? What's the fair value of the adjustment on? Can you see? Any fair value adjustment related to the inventory, and these have been realised by the current year end. So whatever the FVA is, it was on stock, and that stock has since been sold. But it doesn't tell you how big the fair value adjustment is. You're expected to work it out for yourself. Now just to give you a few examples, if we work out the book value to be 680, then the fair value adjustment will be 680 compared to 710, it'll be 30. If the book value turns out to be 610, then 610 compared to 710, the fair value adjustment would be 100. If. But what we can do is we can actually work out what the book value is in our head. Now, share capital won't have changed since acquisition. What is the share capital now? It's 500, isn't it? Share premium is share capital. Share premium is premium share capital. So that won't have changed. But the retained earnings is now 200. And obviously it won't have been 200 at acquisition. But what was it at acquisition? Can you see in paragraph 1? It was 100. So if the retained earnings were 100 and the share capital and the share premium were 500 and 100, then 500 plus 100 plus 100 gives us a book value of 700. So the book value was 700. The book value was 700. The fair value was 710. And therefore the fair value adjustment is 10. The fair value adjustment at acquisition was 10. Okay? And we'll write this all down when we actually come to do the question later in the next recording. But I want to do a recording now to talk it through with you. And what else do I want to talk through with you? Well, the examiner's got a trick in paragraph 2. Did you notice he gives the retained earnings of Trigger in paragraph 2 to the tune of 50, and he also gives the retained earnings of Dell to the tune of 150 in paragraph 2. Now, who is being bought in paragraph 2? In paragraph 2, Trigger is being purchased. So what we want to know is how big Trigger is when it's purchased, and therefore the figure of 50 is relevant. But we don't care how big Dell is when we're not buying Dell. In paragraph 2, we're not buying Dell, so the figure of 150 is irrelevant. And that often happens in examination questions where the examiner gives you information which is completely irrelevant. It doesn't matter how big Dell is when it's not being acquired, because it's not being acquired in paragraph 2. What we want to know is how big Dell is at acquisition, and that's given in paragraph 1. So the 150 is irrelevant. Okay? Over the page. The group operates in the pharmaceutical industry and incurs a significant amount of expenditure on the development of products. These costs were formally written off to the income statement as incurred, but then reinstated when the related products were brought into commercial use. The reinstated costs are shown as development inventory. The costs do not meet the development criteria in IAS 38 for classification as intangibles, and it is unlikely that the net cash flows from these products will be in excess of the development costs. In the current year, Dell has included 20 million of these costs in inventory. Now what the examiner is doing is just going, yeah, trying to bore you to death when he tells you the important information in the very last line. In the current year, Dell has included 20 million of these costs in inventory. But is it okay to include these costs in inventory? No, it isn't. Excuse me, I'm losing my voice. As it quite clearly says, these costs were written off. Is it okay to write off costs when they fail to fulfill the criteria in IAS 38? Absolutely. Those costs must be written off. But once they're written off, they're dead. And when they're dead, they stay dead. We don't pull them out and sort of have zombie costs coming back from the dead and sitting on the balance sheet. Zombie costs are not allowed. Once costs are dead, they stay dead. So what was right was to write them off. What was wrong was to reinstate them on the balance sheet. And the error was to the tune of 20. And obviously that correction needs to be made. But the question is, who has made the mistake? Is it the parent, the mid-sub, or the lower sub? Well, it's Dell. Which entity is that? Well, that is the mid-entity. In fact, if you're specifically thinking about which figure is wrong, if you look on the inventory, you'll see the three figures of 300, 135, and 65 in inventory, and it's the figure of 135 in the middle that is wrong to the tune of 20. And as part of our process of consolidation, we're going to be correcting Dell's figures. Now, in real life, you wouldn't do this. If you were the director, the financial director of Rodney, and you discovered a mistake down in Dell, you wouldn't correct it yourself. You would phone up Dell and tell them to correct it. Get them to correct their books and then send you over a proper corrected set of financial statements. And then you would do the consolidation then. You wouldn't do corrections for them. You would tell them to do it and probably give them a slap as well for being so stupid. But so in real life, what you would do is phone them up and give them a slap. and tell them to write off those costs. You can't have zombie costs, you cannot bring costs back from the dead. That is what you would do in real life. But in the exam you can't phone anyone up. In which case in the exam you have to make the correction for the entity itself as if you had access to its books. So we are going to correct Dell to the tune of 20 in inventory. Now that's what you might call an easy supplementary paragraph. We have 3 supplementary paragraphs, and you always have at least 3 supplementary paragraphs in group accounting. Sometimes you only have 3 supplementary paragraphs. Sometimes you have 4, and sometimes you have 5 supplementary paragraphs superimposed on top of the group accounting. You always have at least 3, and this one has only 3. And they're always of, a sort of a flavour as follows. There's an easy one, there's a hard one, and there's one in between. So there's an easy one, there's a hard one, there's one in between. And that's certainly true in this case. Actually, paragraph 3 is the easy correction. Paragraph 4 is a little trickier. Dell had purchased a significant amount of new production equipment early in the year. The cost before trade discount of this equipment was 50. The trade discount of 6 million was taken to the income statement. Depreciation is charged on a straight line basis on a 6-year period. Now, what is the question? What is the question asking us to do? It's saying prepare a consolidated statement of financial position. Prepare a balance sheet, in other words. But what are we being told in paragraph 4? Dell had purchased a significant amount of new production equipment early in the year. The cost before trade discount of this equipment was 50. The trade discount of 6 million was taken to the income statement. Now there is an error as regards recognising the trade discount in the income statement. There is an error in the income statement, but I've got something to tell you. You're not doing the income statement. So you're not going to correct the income statement because you're not doing it. It is true in real life you would correct the income statement as well as correcting the balance sheet. But because you're only doing the balance sheet, you have to think of what the correction is in the balance sheet. Well, let's have a look at the paragraph again and see if we get a flavour for this. Dell had purchased a significant amount of new production equipment early in the year. The cost before the trade discount of this equipment was 50 and the trade discount was 6, and therefore what we really paid was 44. Now if you really pay 44, how much do you pay? 44. And therefore what should you recognise? 44. But what have we recognised? We've recognised the fixed asset at 50. And we've recognised the trade discount of 6 to the income statement. Now, I know that trade discount of 6 to the income statement is wrong, but I want you to forget about it because you're not doing the income statement. Just concentrate on the error on the balance sheet because that's what you're doing. Now, if you state the tangible fixed assets at 50 instead of what should be 44, then you're overstating the property, plant and equipment by 6. Do you agree? So, if you state the figure at 50 when it should be 44, then your overstatement on the balance sheet is 6. But the thing is about this overstatement on the balance sheet is it's an overstatement on the balance sheet on property, plant and equipment. And the property, plant and equipment is itself depreciating. So what we need to know is not what the error was when it was originally made, but how much of the error is still on the balance sheet. Now the error is on the property, plant and equipment, and the property, plant and equipment is depreciating, so the error will be depreciating over, as you can see, 6 years. Well, if the original error was 6 and it's depreciating over 6 years, then one of those 6 will already have gone to the income statement, in which case the amount of error still on the balance sheet is 5. So the balance sheet property, plant and equipment has been overstated by 5. Originally the error was 6, but now the remaining error is 5. And it's very cute. Flick over and have a look at the balance sheet figure for property, plant and equipment in Dell. Do you see the figure of 505? The way the examiner wrote this question is he started with 500 and then added the error of 5. and we're going to take it back out again and work back to the figure of pure 500. Okay? Now I'm just going to do that again very quickly. If you want to look at that again, there's lots more notes in the answers, as I mentioned. But just reminding you again, we're doing the balance sheet. So we don't care about the error on the income statement. But there is an error on the income statement to recognise a trade discount of 6. But never mind about that. What's happened on the balance sheet? Well, on the balance sheet, instead of valuing the property, plant and equipment at 44, we've valued it at 50. So we've overvalued it by 6. But that overvaluation of 6 is on property, plant and equipment, which is depreciating. And the amount of error that's still left on the balance sheet is 5, because 1 of the 6 has been depreciated. Okay? That's the medium one. Now the really hard one is paragraph 5. Now in the examination it is almost impossible to do all of the paragraphs that you are given in question 1. So what you try and do is you try and do all of them, but one. One of them, you'll pick it out, it'll be the one that you can't do. The one you can't do, don't try and do it. Or if you do try and do it, try and only do half of it. Okay? Don't try and get it perfect. If you try and get the answer to question 1 perfect, then the trouble is, all you'll do is spend your entire examination on question 1. There's only 35 marks available. If you get this perfect, you might just get 35. But the problem is you'll get 35 out of 35 in this and won't do anything else in the entire exam, and you'll score 35 out of 100 as well. What you really want to do in the exam is bash this out as fast as you possibly can and get into the B section where there are 65 marks of narrative. Or should I say you want to get into the narrative where there are 65 marks of narrative. Okay. Paragraph 5. Let's have a look at it together. It's very tricky. The policy of the group is now to state tangible non-current assets at depreciated historical cost. The group changed from the revaluation model to the cost model under IAS 16, property, plant and equipment, at the current year start, and restated all of its tangible non-current assets to historical cost in that year, except for the tangible non-current assets of Trigger. These have been revalued by the directors of Trigger on the first day of the current year. Unbelievable. What has happened is, in the very year that Trigger is switching from cost accounting to revaluation accounting, the other two are switching from revaluation accounting to cost accounting. Check it out again. The policy of the group is now to state tangible non-current assets at depreciated historical cost. In other words, the policy of the group is to do cost model. The group changed from the revaluation model to the cost model under IAS 16. So they used to do revaluation accounting, but now they're going to do cost accounting. And when they did it was at the current year start. Gosh, look at this. It's unbelievable. The policy of the group is now to state tangible non-current assets at depreciated historical cost. The group changed from the revaluation model to the cost model under IAS 16 at the current year start and restated all of its tangible non-current assets to historical cost in that year, except for the tangible non-current assets of Trigger. On the very day that the group is switching from revaluation to cost accounting, Trigger is switching from cost accounting to revaluation accounting. Huh? I mean, it's absolutely bizarre, but I have to say, it's the kind of sort of ridiculous nonsense that does happen in real life because the left hand isn't talking to the right hand. Anyway, let's read that sentence that suggests that. These had been revalued by the directors of Trigger on the first day of the current year. So on the first day of the current year, Trigger went from cost accounting to revaluation accounting. So what we've got to do is we've got to get consistency in accounting. So everybody has swapped from revaluation to cost, except Trigger, which has swapped from cost to revaluation. And what we've got to do is take it back from revaluation to cost. We've got to take back from revaluation to cost. Now, essentially what we need to do is get rid of that revaluation reserve. Because you can't have a revaluation reserve if you're doing cost accounting. So I mean, the quickest way to get rid of that revaluation reserve is just pick it up and drop it. Obviously, your balance sheet won't balance, but it wasn't going to balance anyway, right? So just pick up that revaluation reserve and drop it, and then you'll get rid of the revaluation reserve. Trouble is, that's not quite right, is it? Because the thing is about a revaluation is not only does a revaluation create a revaluation reserve at the bottom of the balance sheet, it also pushes the assets up at the top of the balance sheet. So what we need to do is we need to reduce the tangible fixed assets at the top of the balance sheet. Do you see the figure of 256 in trigger? That figure of 256 needs to come down. Now the temptation is simply to take the 70 from the revaluation reserve out of the revaluation reserve and just sort of bang it off against the top of the tangible fixed assets and reduce the tangible fixed assets in trigger by 70. But that's not actually quite correct, and that's why this is a prize-winning point. Reading on. So what was going on? These had been revalued by the directors of Trigger on the first day of the current year. The values were incorporated in the financial statements, creating a revaluation reserve of 70. So when the revaluation first took place, we had a revaluation of 70. And now, 12 months later, the revaluation reserve is still 70. So it hasn't changed. The tangible non-current assets of Trigger were originally purchased on the 1st December, 2 years before the current year end. So 2 years before the current year end, we made the purchase of the tangibles, and 1 year ago we revalued them. Okay? The tangible non-current assets of Trigger were originally purchased on the 1st of December, 2 years. Where are we now? I lost my place. 2 years before the current year end at a cost of 300. These assets were depreciated over 6 years on the straight line basis. The group does not make an annual transfer from the revaluation reserves to the retained earnings in respect of the excess depreciation charged on the revalued tangible non-current assets. There were no additions or disposals of the tangible non-current assets of Trigger for the 2 years to the current year end. There it is. There's the prize-winning point. It says the group does not make an annual transfer from revaluation reserves to the retained earnings in respect of the excess depreciation. Now this is, believe it or not, on the syllabus at F7. It would definitely be an absolute prize-winning point at F7. And here at P2 it's like a double prize-winning point. But nevertheless, the transfer is compulsory. The idea of a transfer is that you realise a revaluation reserve. Now, if I can come away from the numbers that are actually in this question and just talk about the process of realisation more broadly, the idea is if you buy some land and you revalue it up by 100 million and then you sell that land, then that revaluation gain of 100 million becomes realised. So you would take that 100 million out of the revaluation reserve and drop it down into the retained earnings. Okay? So that would be the process of realisation. That's realisation on sale. So just to do it again, if you buy some land and then you revalue it up by 100 million, you get a revaluation gain of 100 million, and that revaluation gain of 100 million goes into the revaluation reserve. If you then sell that land, that revaluation gain becomes realised, and you take it out of the revaluation reserve and you drop it into the retained earnings reserve as it becomes realised. Okay? Now that's called realisation on sale, and I think it's fairly intuitive, and I think you'd be fairly comfortable with that. But there's another type of realisation which is called realisation on use, and that's the one in paragraph 5. But I'm still going to stay away from the numbers that are actually in paragraph 5. I'm going to stay away from the numbers that are in paragraph 5. Now let's have a revaluation of some plant. Some property, plant and equipment, some plant. The revaluation at the beginning of the year is 80. And the remaining life of this plant is 8 years. Now the plant itself is depreciating from where it is now down to 0 over 8 years. So the idea is the revaluation reserve should drop at the same rate. So if the revaluation gain as at the beginning of the year is 80, that revaluation gain of 80 will go into the revaluation reserve. But it's realised over the life of the plant, the remaining life of the plant of 8 years. So you take 8, you divide it into 80, and you get 10. And what you'll do is, at the end of the first year, you will release 10 of that 80 from the revaluation reserve into the retained earnings, and you'll be left with 70. And then you'll do exactly the same the following year, where you'll release 10 and you'll end up with 60, then 50, then 40, then 30, then 20, then 0. So the figure for the revaluation reserve goes down to 0 over the period of use. Now that's called realisation on use, and it's effectively compulsory, and these guys are not doing it. Just read it again. It's difficult to say, but it's true. They're not doing it. The group does not make the annual transfer from the revaluation reserve to the retained earnings. So they're failing to do realisation on use. So they should be doing realisation on use. Now you can definitely tell they haven't released any of the 70 into the retained earnings, because that figure of 70 on the balance sheet is 70. Do you see it? Well, that 70 was 70 at the beginning of the year, and it's still 70 at the end of the year. So they definitely haven't released any. So they need to release some. But how much? Well, what they need to do is they need to release an appropriate amount depending on the life of the asset remaining when the revaluation gain came into existence. Now, this is the really tricky thing. Stand at the year end and remember the life of the entire life of the plant. Do you remember the entire life of the plant? The assets are depreciated over 6 years. So if the assets are depreciated over 6 years, then what is the remaining life at the point of revaluation? Well, I don't know. When were the assets purchased? Well, the assets were purchased 2 years ago. They were purchased 2 years ago. So standing at now, the revaluation was at the beginning of the year. The revaluation was at the beginning of the year, but the purchase was at the beginning of the year before. So how many years did the assets have left when you bought them? How many years were remaining at the point of purchase? Well, 6. Well, after 1 year, how many years remained? 5. Of course, at the point of revaluation, the remaining life of the asset was 5 years. So what we need to do is we need to release a figure of 1/5 of the 70. Now, 1/5 of the 70 is 14. Now, can you see that they have a figure of 70 for the revaluation reserve? Even if they stuck with revaluation, which they can't, but even if they stuck with revaluation, they would have to transfer 14 of that 70 from the 70 down into the retained earnings. So let's imagine that they've done that. If they do that, the 70 goes down and the 60 goes up. So the retained earnings will get a hit of 14 and they'll go up to 74. So the retained earnings go up to 74, but what does the revaluation reserve go down to? It goes down to 70 minus 14 gives you 56. Then the 56 is removed by taking the 56 and banging it against the 256 at the top of the balance sheet for tangible fixed assets. If you take 56 off 256, you've got 200. Huh? Does that sound right? I don't know. What we're trying to do is we're trying to get back to the figure that we would have had if we'd never messed with revaluation at all. Well, how much did these tangible fixed assets cost 2 years ago? I don't know. What does it say in paragraph 5. In paragraph 5 it says they cost 300 and their life is 6 years. If we'd always stuck with tangible fixed asset cost accounting, then we would have taken that 300 divided by 6 and got depreciation of 50, would have charged 50 in the first year, 50 in the current year, and we'd have 200 left. And we will have 200 left when we take the 256 out of the revaluation reserve and bang it against the top of the tangible fixed assets. Now that is completely impossible. I think you've got to agree with me. There is no way you can work out all that nonsense in the examination and actually expect yourself to finish the rest of the examination. That would take you, just paragraph 5 could take you 3 hours just on its own. Do you agree? Although when I come to record this recording and actually write down my answer to this particular answer, I will accommodate all of the detail in that. Actually, in the real examination, I want you to realise that you're going to get stuff like that and you're just going to go and just ignore it altogether and make sure you focus on getting the other two right, which is paragraph 3 and paragraph 4. I think it is important to pick up paragraph 3 and paragraph 4, but paragraph 5, don't get sucked into it. Don't get sucked into that nonsense. Just realise that you don't need a revaluation reserve, bin the revaluation reserve and forget about the rest of it. It's just too difficult. But just to do it back again one more time, what we have in trigger is we have revaluation accounting and we need to remove that revaluation accounting. Now the 256 for the tangible fixed assets needs to get back to what it would have been if we never had have had revaluation. Now if we never had have had revaluation, we would have had a figure of 200 and not 256. Because, you know, the thing cost 300 2 years ago and 50 would have been charged in depreciation in the first year, 50 would have been charged in the second year, and therefore that figure of 256 should actually be 200. So you've got this like dangling debit, as you might call, of 56, and you need to get rid of that 56. Well, what you do is you pick up that 56 and you sort of bang it off against the figure for the revaluation reserve, because you also need to remove the revaluation reserve. Now, when you bang the 56 against the 70, you're left with a figure of 14. And that figure of 14 seems a bit odd. You can't leave 14 in a revaluation reserve because, you know, there shouldn't be a revaluation reserve at all. So what you do is you pick up the remaining 14 and you drop it into the retained earnings. And that figure there for the 14 is the realisation of use related to the transfer that I told you about. The group does not make an annual transfer from the revaluation reserve to the retained earnings in respect of the excess depreciation charged on the revalued tangible non-current assets. In other words, not only were they doing revaluation accounting, but they were doing revaluation accounting wrongly. So what they should have done is they should have transferred 14 down from the revaluation reserve to the retained earnings. But why 14? It looks like that figure of 70 is being divided by 5 and not being divided by 6. Well, that's right, because what you do is you realise the revaluation reserve over the remaining life of the revaluation reserve. Now, the original acquisition of the plant took place 2 years ago, but the revaluation reserve came into existence 1 year ago. And obviously after 1 year's gone, there's only 5 years remaining. So that figure of 70 should have been divided by 5 and should have had a release of 14 from the 70 into the 60, from the revaluation reserve into the retained earnings. If it had had the transfer it should have had, then it would have been a correct revaluation reserve of 56. In which case, when you bring the 56 off the top of the balance sheet to bang off against the revaluation reserve, you would make the revaluation reserve disappear. So there's two corrections to make in paragraph 5. One is the correction of the incorrect revaluation accounting. One is the correction of the incorrect revaluation accounting. And the other is then the removal of the remaining revaluation accounting. So there's two things you must do. You must do the transfer that they haven't done and also reduce the value of the tangible fixed assets. It's tough stuff, isn't it? Now, there's an awful lot more notes discussing this in the answers. But fundamentally, what I'd like you to do is not worry too much about, worry about paragraph 5. It's just like a real exam question. You could spend your entire life just wasting your time on paragraph 5 and it can kill you off. In the exam, you're going to ignore paragraph 5, so why not ignore it in your revision? Why not ignore it now when you're practicing this question? Practice this question and keep ignoring paragraph 5, keep doing it over and over again so you get better at everything else, and then finally, when you feel that you're really good at the basics, then have a go at paragraph 5. Okay? So don't focus on paragraph 5, because it's not paragraph 5 that's going to make you pass or fail. It's the basic complex group, It's the basic complex group structure that's going to make you pass or fail. It's paragraph 3 that's going to make you pass or fail. It's paragraph 4 that's going to make you pass or fail. Paragraph 5 is pretty much irrelevant. And don't forget you've got the fair value adjustment also in paragraph 1. Yeah? And finally in paragraph 6 you've got a goodwill impairment, if I remember correctly. The goodwill resultant from Dell acquisition was impairment tested at the first and second year end after acquisition, and again at the current year end. The first and second impairment reviews revealed no problems. However, the current review revealed a recoverable value of 809 for Dell. So we have an impairment in paragraph 6. Now, if you feel like just making sure you're okay with goodwill impairment, then go back and have a look at those wonderful questions. Terror in particular is the really good question. Fake and stock is the basic one you might remember, but have a look at the wonderful question terror from the previous chapter looking at goodwill impairment, and then make sure you're comfortable with this when we do it together. So the current review identified a recoverable value of 809 for Dell. There has been no impairment in trigger goodwill since acquisition. Finally, prepare a consolidated statement of financial position for the Rodney Group as at the 30th of November 2000. Oh, I keep saying 2000, don't I? But it doesn't say it there. Goodness me, I'm absolutely soaked from just working that through. It's tough. Real exam questions are tough. And there are an awful lot about exam technique and not getting obsessed about the details. So now I'm going to turn off the camera and we're going to stop this recording. And when we come back and do the next recording, when I come back and do the next recording, I'm going to formally work that answer in front of you and show you how this exam question would be approached in the exam. Show you how you should do this in the exam. Okay, that's the end of that recording. I'll see you in the next recording for the actual written answer to Rodney.